Thanks everyone for making the time this morning. I am Evan Edwards. I'm Director of Strategic Partnerships and Business Engagement for Project Equity. Also here on our team are Jason Eby, who is our Operations Manager, Emily Bergstrom, who is our consultant for the manufacturing sector, and Tony Matthews, who leads the California Center for Employee Ownership and is one of the foremost ESOP practitioners in the country. We will have relatively packed schedule for the next hour, so we're just going to get going. I would ask that at the top of their sections of the presentation, Emily and Tony will just give you a couple of minutes on each of their backgrounds. I'll let you know that I am originally from the tech sector, spent 20 years working for startup and early growth tech companies, and joined Project Equity three and a half years ago to develop a scalable model for bringing employee ownership nationally. We're a nonprofit that's based in Northern California, although our team is all over the country. Jason and Emily happen to be in Chicago. Tony's down here in Southern California with me. And we have folks on the East Coast and in South Florida, North Carolina, and other places. A key to our work is enabling legacy business owners, so those that have operated companies for 20, 30 or more years, to have an equitable succession solution. And when I say equitable, one that allows them to achieve a market rate return for the sale of their business. I'm sure you all know that a lot of business owners decide that they are ready to exit and they are unable to find a buyer that's willing to pay the valuation that that's been established for their business. There's friction. A strategic buyer might have a timeline that does not align with the business owner's desire to potentially exit. And so what we do in employee ownership is we help to position a workforce as the buyer, though the workforce doesn't actually have to come up with the financing. And I'll let you know how all of that works, as well as Tony when he discusses more about the ESOP model. Specific to Wisconsin, we see it as one of the really strong manufacturing regions in the country. And we also know that there's a lot of legacy business owners in the manufacturing sector in Wisconsin. And so thus the reason for us having a project specific to the region. So I'll kick into our presentation now. Jason, if you want to flip the slides. So again, our agenda for today, I'll talk a little bit about employee ownership and the environment. Emily will discuss our strategy and some case studies, and then Tony will talk about ESOPs. So as I mentioned, we work with owners of small and medium-sized businesses to help them achieve liquidity, secure a market rate return, and retain their business legacy. The method with which we do this happens to be a leverage buyout, which is driven by the Project Equity. We work with financiers who will bankroll the transaction and do so in a manner such that the workforce is not obligated to any financial commitment. Rather, the funding for the loan, the debt service is through the business's going forward cash flow. So something that most folks don't know about employee-owned company, they happen to actually be fairly strong once they've been converted to employee ownership, regardless of their strength beforehand. Employee-owned companies traditionally have higher profit margins than non-employee-owned companies, excuse me, and they tend to grow a little bit faster. Part of the reason for that is you have the ownership culture. If the entire workforce understands that they have skin in the game, that they have some equity stake, they work a little bit harder, the commitment is higher. Some of the unique benefits of employee ownership. So owners can achieve a fair sale price. Median job tenure is longer. an employee household net worth is higher, we see this as a win-win-win. It's obviously a win for the business owner, it's a win for the worker, and it's a win for the local communities where businesses end up staying rather than be closing or being sold to an out-of-market buyer. We also know that there are fewer layoffs with employee ownership, so this speaks to the point of it's better for local economies. We always hate to see when a buyer comes in for a business, comes into a community, and then decides that they're going to lay off a bunch of the employees and operate the business as an asset. We all know that selling a business isn't easy. You're probably not familiar with these statistics, but only about 20% of all businesses listed for sale actually sell, and even smaller percent sell for owner's asking price. About 15% transition within families. This is significantly lower than even 20 years ago. About 20 years ago, our research indicates that about 1/3 of businesses transitioned within families. Now, of course, that's like only 15%. You see in combination, 20% selling and 15% transitioning in families. That means that that's only about 35% that actually transitions. 1 in 5 are at risk of closing. So there are succession options that are out there, selling to family members, acquisition, and employee ownership. And you notice on this particular slide, employee ownership is the only one that checks all of the boxes. So the advantages. I'm just going to pause here and let you all read through these advantages. Okay, the current environment. So working people aren't economically secure. I think the whole COVID crisis has rendered that even more obvious, that we see that how many folks have been put in positions where they're not able to have sustainable economies. And we find that that's even more the case in sectors that don't have employee ownership as part of the model. When employees have a stake in ownership of the company, they're able to make decisions that allow the business to be sustainable in a manner such that more employees are able to keep their jobs, keep their incomes, and remain a viable part of the economy. So the silver tsunami, you all might be familiar with this phenomenon. The silver tsunami refers to baby boomers who own the vast majority of small and medium-sized businesses in the country. And those folks happen to be at a critical time where many of them are retiring. And if you recall back to the slide that I mentioned prior, where only about 35% of businesses sell, we're actually entering a period of time where businesses, by and large, owned by baby boomers, are going to end up shutting down, or if they are sold, are going to be sold at a selling price that's way below that which the owner would otherwise be able to achieve in other times. The silver tsunami is a real risk, in particular in communities that have legacy businesses, particularly like the manufacturing sector, other industrial type businesses. So employee ownership, why is it viable? Why is it important? And how do we know if a company is ready for it? A company should be profitable. There should be experienced employees such that once the business is transitioned and debt is in place, supporting that transition, it can operate at the same level or even an improved level going forward. Experienced employees are a key part of that formula. And then a proven track record. So the employee ownership transition process is not, it's not more complex than any other strategic deal. As far as mergers and acquisitions concerned, it actually has a lot less friction, because you're not looking at a potentially adversarial buyer or acquirer. You're not looking at a circumstance where the due diligence is skewed in order to look for advantages for the purchasing party. Rather, because the owner is selling to the employees, the process is fairly frictionless, and the owner can control the pace of the transaction and how the transaction plays out. It usually starts with exploration, so understanding more about employee ownership. Um, Project Equity then conducts a feasibility assessment. In that feasibility assessment, we understand that the business would be viable as an employee-owned company. And once we ascertain that, we then move into the transition phase. And that's where all of the change management, financing, sale agreement, et cetera, all of that is conducted at that stage. Of course, then we close the sale. And part of our model is, uh, uh, excuse me, to clear my throat there, is our Thrive program, which essentially helps businesses to survive and thrive after employee ownership, ensuring their success, the success for the employees, and of course that they're able to service their loans going forward. So selling the business is pretty self-explanatory. We establish a sale price, deal terms, and finalize. New employee-owned business obtains a loan. And then, as I mentioned, the loan is paid through future revenue. I'd like to kick it over to Emily. Emily, again, is our manufacturing specialist, and she has a few case studies to share with you. And so with that, I will pass the baton.
Thank you. I'll give just a quick background on me. I started working in manufacturing in 2006. I worked at a company called McMaster-Carr. If you've walked around a manufacturing plant, you've probably seen a big yellow catalog. You know, they're like a Grainger. And I spent 12 years with them, visiting all kinds of manufacturers, suppliers all across the US and globally. And had an opportunity to talk to a lot of owners during that time and get their perspective. And one of the things I learned that I'm, trying to bring to Project Equity is that everybody in manufacturing sees themselves as niche and special and different. And so, I'm sure you guys run across this. You'll tell them, hey, well, we've got this thing that worked for this person, and they'll say, well, that's a metal stamping company, and we're an injection molder, or we're doing whatever different thing. And so a lot of times they don't see that how what they're doing translates to other businesses. And so we wanted to start off just with a few case studies that are hyper local to you guys' area, so that you can, share these stories potentially if you come up in conversation, and they, can have some examples of companies very similar to them that have seen success with employee ownership. And the examples that I chose, if you can start the slide, Jason. The first one that I picked is one that I think shares a lot with what you guys might see talking to owners. Hellwood Carbon, they're in Milwaukee, and they've got a third generation that's running the company right now. And the situation that they had a couple of brothers who are owners. They want to maintain the family legacy, that they want their, these two children, cousins, to continue running the company, but they also need to diversify, as aging owners. And so what they did was they started a sale process where 25% of the company is employee owned, and they're sort of splitting the difference. They're getting some diversification of assets for that selling, older generation. They're preserving control and value for the younger generation, and employee ownership is a really good way to do that. So they have seen, I spoke to Jay, who's one of the brothers that owns it, and his son is pictured there. I think his name is Jason. And one of the things that they liked was that they controlled the pace of the sale. So they, at this point, decided that they were going to sell 25% to employees. And that was enough for them to start to see sort of an ownership change in culture in the folks who are working there. And then, it leaves it leaves a lot of the company in the hands of their children, and then they can make the decision as they move forward. Maybe they want to stay in the business, maybe they don't. Um, but you can't find a buyer in an open market who is going to be satisfied buying 25% of the business. You know, that flexibility doesn't really come in other types of sales. And so I wanted to start out with this one just to show that when you're selling to employees, either directly without a bank loan or with a bank loan, you just get so much more flexibility in the timing and the control than you would with an outside buyer. And so for the next one, so that was Hellwig. This is Hatco. I don't know if you guys have heard of them. They're up in Sturgeon Bay. They're a pretty big company, and they do food service equipment. So like warmers, refrigeration, heating, all kinds of stuff to do with food. And it's kind of interesting. So this owner, he started the company. He has since passed away. The older generation didn't have any children. There wasn't anyone around who wanted to in their family that they could pass the business along to. And the owner said for many years that he was going to sell to his employees, but when it came time to sell, they didn't really know what to do. And I think I've heard other owners say this before, like, well, I don't have to figure out what I'm going to do in my sale process because I'm going to sell to my employees. And I think one of the things I would love to see communicated more to owners is that you have to really start the process early and be thinking ahead to set yourself up for success and have options when it comes time to sell. And so even when people say that they want to sell to their employees, they have to learn about it. It's helpful to do this years in advance. This Hatco is 100% employee owned now, but they did this sort of slower transition. They brought in an outside CEO to take over, and it's really worked well for them. They're doing great. I mean, they're a huge company, but it's this reason I like this story is the owner sort of thought ahead, and he had this plan for many years and was able to execute it really gracefully. The more runway that you have when you're making these decisions, the better it turns out for the employees and for the retiring owner. And then we'll go to the third one, Mayville Engineering. I don't know if you guys know this one, Mayville. They're a contract manufacturer. They're big, and I love this story because similar. They had retiring owners. They're employee owned 80%, and I think it's been since 1985. It's a long time ago. And now this employee-owned company, Mayville, they have acquired other companies. So they've really become a powerhouse. I think that they've done 2 or 3 different acquisitions since they become employee-owned. And I like this story because it challenges the idea that the employee-owned company is like operating in some different way than a quote unquote regular company or like a family-owned company. I mean, these guys are strategic acquirers. They're they're really movers and shakers in their business. They win all kinds of awards as a contract manufacturer. They're competing really well with a lot of international companies, and they're doing this, of course. As an employee-owned company, there's no difference. They can have exactly the same sort of management structure and strategic bent as any other kind of company. And the COO, he's a Michigan State grad like me, and he talks about just look at the track record, like look at how they've grown, look at how they've performed. It's possible that converting to employee ownership can start like a new level of growth, and I really like this story for that reason. And so these are all sort of heavy industry kind of manufacturers in the area, and we're happy to share these slides and tell other stories. You'd be surprised how many employee-owned companies already exist in Wisconsin. There's just a ton of stories, and I think having a couple of those in your pocket can really help the conversation, because what I found, for example, is Jay, the first case study that I shared, he's really open to talking to other owners who are trying to make this decision. And when he was deciding whether or not to sell to employees, he ended up being connected with other owners. And I think that sort of matchmaking is a role that you guys could play that could be really good service, is just putting people in touch with others who've gone through that process. There's nothing that could sell it better. I mean, certainly hearing from us is really different than hearing from other owners who've gone through the process. And I think that that's, that's a way that we can help each other. So the next thing I just want to go through is sort of what do we do? Like when we say that we're opening up and we're expanding into Wisconsin, what does that mean? Like, what is our strategy? And I'm taking a lot of this from, skills that I learned when I was at McMaster-Carr doing product management, and ways that I'm looking for a company to buy in the Chicago area, and sort of, the way that I go about this is really similar, and it's all data driven. So we're looking here at Milwaukee specifically just because that's such a manufacturing center, but we kind of want to keep our eye on all of Wisconsin. But, there's 2,700 businesses in Milwaukee that are over 20 years old. We tend to see, that sort of like founder led or second generation led company as being, the best suited for a transition. These companies account for a ton of small business revenue. They're really a powerhouse in the Milwaukee area, and there's 64,000 workers that are working for these current companies. And you guys, I know, talk to business owners, and you also talk to people who are working with state economic development agencies and other vested interests who want to see employees stay in the state. And when I think about the vulnerabilities of Wisconsin, especially manufacturing, you guys have seen how easy it is for an outside buyer to come in and close up shop and move it to Mexico or wherever else. And these are really the reasons that I think employee ownership makes sense to stabilize areas. So anyway, we'll go to the next slide, and I'll just talk about sort of how we think about things. So first, we have size and industry targets. We look for aging owners. I love when I'm looking through kind of prospecting for project equity when I see that there's like a philanthropic arm with the company, or you see a lot of like messaging about volunteerism or company culture. You can kind of tell the owners who are really engaged and care about the workforce, and those often tend to be good prospects for conversations with employee ownership. And then, I also have learned a lot about sort of what private equity looks for in businesses, and they have investors that they have to feed. They have to grow the company at a certain rate, and they really become they have a lot of preferences about industries. And so one thing that I look for coming at this from an employee ownership perspective is, what are industries that are not popular with private equity? Because that means that those owners are going to have less options when it comes to sell. And they're the ones that really need to hear the message about employee ownership as an alternative, because, like Jim was saying at the beginning, they may not know that that exists, and they may not have other buyers that are in the lanes. So one is, we just have this sort of data-driven, data centric approach to finding companies that are the right size and the right profile. And then we also spend a lot of time building friends, networks. Who do we know that talks to owners who are selling? And this is a place that we love having a conversation with you guys, because we like to know who do you talk to? Who are the finance professionals that are good referral partners for you too? Or what trade associations do you know that are respected in that area? We focus on different industries in each region that we go to, and we're looking at metalworking and food manufacturing as good industries to target in Milwaukee because they're so prevalent. So anyway, going to the next one, we'll just talk about what it looks like what do we see in Milwaukee. So these bubbles represent how much money a company makes and how many employees they have, and it's sort of the intersection of those two stats that help us determine size. We want to see companies that are big enough to support an employee ownership model, we want them to be ideally over the 5 million in revenue mark, but the smaller ones can do other employee ownership models like co-ops. So anyway, there's 80 top prospects, really big companies that seem like they have an aging owner, that seem like they have the right sort of cultural setup for employee ownership. And then there's 150 that are more of the mid-size. And so this is the starting point for me. I basically just work through this list and start to reach out to people. And working in collaboration with you guys is really exciting because, as I was looking up different companies, I would find people who, were shared LinkedIn connections with you, and reaching out initially to an owner with a friend with a warm intro is so much more effective than just cold calling someone. And so I think that there is a good potential for this relationship building that you guys are doing and that we are doing too, to be mutually beneficial. And then the next one, just I wanted to throw out some names of places that we're already sort of like looking to either make friends or expand our networking with. We like to meet business bankers, business brokers, ESOP advisory firms, local business groups. Vistage, that's the one that Jim, you had recommended to us. BizTimes was one that you had recommended. And we love to sort of hear from you guys' perspective, because you're much more, in the local community than we are, and just knowing from you who's trusted, who really has their ear to the ground when it comes to these owners. Those are really helpful resources for us, and you guys have been a great partner with that already. And that's it's key to our strategy and growing our influence in the area.
Okay, first of all, this notion of putting company stock into qualified retirement plans, which is what we're talking about. This is, and I'll take you through how this fits together, is relatively new. It started in the 70s. And the types of arrangements nowadays that are available where you can use qualified retirement vehicles with ESOP, with employee transitions of ownership, begin with a basic profit sharing plan. You can create profit sharing plans, and a lot of the early ESOPs were just profit sharing that had been qualified to accept employer securities as an investment. You can add deferrals and matching and other features just like you can in any other profit sharing plan. The most common one is the ESOP, Employee Stock Ownership Plan, but it's basically is a defined contribution retirement plan. It's just like any other defined contribution plan, with a couple of exceptions. And I'm just going to kind of run on to take you through those. So what the ESOP is, it's a defined contribution plan, just like profit sharing or 401k, but it has two material differences. This is the only type of plan to which these two things are available. One, it's required to invest primarily in stock of the company that sponsors it. So whereas your profit sharing plans and 401ks and other things have limits on how much they can invest in employer stock, ESOPs are required to invest up to 100% of their assets in stock of the company that sponsored it. And the second feature that makes an ESOP different is that it can borrow money, and it can use the good faith and credit of the company as collateral in order to do that. So we have regular ESOPs and leveraged ESOPs, and a leverage is just one that's taking advantage of that ability to borrow. If you think about it, if you have this vehicle where all the contributions are tax deductible because they're in a qualified plan, all of its assets are untaxable, and it's required to invest in company stock, and it can use credit to get there, you create a really flexible tool. It's as a tactic, it can do a lot of things that nothing else can do. Like providing tax-free revenue to the company, all kinds of things can go into it. With ESOPs, when we use them in the right way in companies, we do get a bunch of non-financial benefits that people have already talked about. This idea of creating a motivated, engaged employee group, the incentives to, do what can be to really broaden the value of the company, and this culture of ownership. They do come up, although there's nothing automatic about it. As I said earlier, if you can have an ESOP, and it can have 100% ownership of the company, and your employees may not even know about it. They get a statement once a year that says what the value of their account is. They don't, and the idea of voting and so on is all dealt with through the construct of the ESOP, and that is more that it's this qualified retirement plan. The owner of record of all the assets of an ESOP is not the individual employees, it's the trustee of the ESOP. That trustee, as you'll see as we'll go through further, is appointed by the board of directors of the company. And the trustee for every purpose, the voting and buy, sell, and all the other is the trustee of the ESOP is the shareholder. And in this non-financial end of it, companies voluntarily decide whether they're going to engage the employees. The financial benefits of it we'll go through in more detail, but they're pretty, come on, Tony, pretty significant. You can get tax deductible financing for principal and interest on any financing you do. You can create an ability for the sellers to defer tax on any capital gains on the sales to the ESOP and defer them indefinitely. And you can get tax-free earnings out of a company if you use the S-Corp model in a current ESOP. So the impacts are pretty significant. Let's talk about the first one and how that works. Financing is all pre-tax because ESOP contributions are part of the regular retirement plan contribution, cadence. That means that they're fully deductible for the company, no matter how it's applied. So you can have a basic ESOP structure which doesn't have any leverage attached to it. The company can just make contributions to the ESOP out of its earnings and profits, which is fully tax deductible. The ESOP it's required under law to use those funds to acquire shares from the current shareholders. Over time, the ESOP trusts can accumulate large amounts of ownership in the business, and therefore the employees are receiving that. The one that's most common today is what we call leveraged ESOPs, where there's financing involved. For business succession, the sort of slow process of contributing cash and buying stock takes a long time, but we've run into in the last year, a couple of decades at least, a real pressure to create succession strategies. And so we've got banks coming into the system. Just understand that the leveraged ESOP is either a bank financing or more and more today, probably 2/3 of the ESOPs that I'm working with today that are leveraged are doing it with seller financing, so that the shareholders themselves are just providing, sales for promissory notes, and they're getting their payment as that goes on. Now, the big difference between the regular non-leveraged ESOP and leveraged ESOP really comes also in terms of how the employees' benefits accrue. If you have a leveraged ESOP, whatever company stock has been purchased and is subject to debt repayment, those go into a suspense account. They're not automatically added to participant accounts. So the employees are not getting, on day one of a leveraged ESOP, the ESOP may become 100% owner of the company, but none of the employees have any access to any of that because it's all in the suspense account. And then over time, and this is just under a formula that's provided in law, as that debt is paid down, the shares that have been paid for effectively are released and allocated. So every year you get a batch of shares allocated, and the employee accounts grow and the suspense account shrinks. And so you wind up over time creating the allocation of the shares. So in this context, you can become 100% ESOP owned company, but none of the employees have anything in their accounts because the full debt is outstanding. And then as the debt goes down, the stock goes into their accounts. That as this is paid off, the employees are seeing more shares added to their accounts, but they're also seeing an increase in value because of the elimination of debt. So it's a pretty easy sale in the early years of an ESOP. The fair market value, I know we said earlier that something otherwise, but ESOPs are required to have independent third-party appraisals done at least every year for purposes of benefits, and anytime there's a transaction. So if you're buying stock from a shareholder, it's going to have to be done by the trustee. And this is an independent third-party appraiser that's hired by and answers to the trustee of the ESOP, not to the company. And it really has to be somebody who's not related to the company otherwise. The ESOP is not allowed to pay more than fair market value, and the regimen that people go through to create that fair market valuation starts with a value of the assets. They look at the earnings history of the company and capitalize that. They look at the most common impact on current value is a future cash flow, which they can calculate back to a present value with discounts appropriate and so on. And then they do look at some comparable companies in the public markets to get some of the points of reference. It's a very rigid process. The appraisers that do this kind of work are unique. Really, they're not, don't usually do anything but this kind of work because the requirements of ERISA are such that you can't really, you can negotiate a price, but it's got to be ultimately no more than fair market value determined by this individual, these independent appraisers. There's usually a lot of concern over what kind of control employees have, and the truth of the matter is, by law, none. The board of directors of the company, which is elected by the shareholders, and in this case that means appointed by the trustee, who is also appointed by the board of directors, create that circular reference. But in the end of the day, the amount of engagement and the amount of employee activity or employee input is really up to the companies as a whole.